Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. It has been a dramatic few days in the crypto space, and we need to unpack the events that have unfolded, most of it related to the FTX exchange and their buyout by Binance. We'll walk through each of the pieces of this story as they unfolded in the public square on Twitter, how they affected the markets, and what we think it means going forward. We'll also touch on the inflation report that's coming out and where we are currently in the bear market process. All of those things will be addressed in this video, so don't go anywhere. If you enjoy my content, make sure to give this video a thumbs up and subscribe to my channel. I appreciate all of the support you guys give me here on this channel, on Twitter, and on my newsletter. It really means the world to me. Thank you so much. Now let's get into the business. Woo! What a day yesterday, friends. The crypto space endured another dramatic sequence of events with the insolvency and buyout of the FTX exchange. We'll unpack all of the events there. I was tracking it in real time, and it was a fascinating sequence. But it has brought down most of the industry in price in the last couple of days. You're looking at Bitcoin here sitting at the year-to-date lows. This over here is the low from June. And if we zoom out, it's the lowest price since late 2020. So right now, Bitcoin has already wicked below a couple of different times. It's currently at 17,500 and it's trying to make its way lower. We've been watching these prices on this channel now for the last couple of months. Even though we've been making videos less frequently, the theme of the price action we've been watching hasn't changed very much. My belief has been that we would threaten lower prices at some point. It was just uncertain what the catalyst would be. Maybe this is that catalyst. It's hard to know in the moment. We won't be able to say that with confidence until we get a little further away and we can look back. But this could be the event that drives the space into a lower level of hell. So where did all of this begin? Well, about a week ago, a story dropped by CoinDesk investigating the holdings of Alameda Research, which is the predatory arm of FTX. Both FTX and Alameda are owned by Sam Bankman-Fried. And what the report found was that many of Alameda's holdings were illiquid shitcoins. They had billions of dollars locked up in FTT, which is the exchange token for FTX and is essentially worthless. They also had another couple billion locked up in Solana and a couple of other shitcoins. But the real kicker here was that billions of dollars worth of their valuation was tied up in FTT and FTT-based collateral loans. So essentially, most of their valuation is propped up on Vapor by a token that is only used within the FTX ecosystem. And shockingly enough, this amount of FTT that they claim on their books in assets is essentially the size of the FTT market cap at its height. So if we go over here and we look, this is the FTT market cap here as recently as August and September, and it was about $3 to $4 billion. So the amount of the market cap of FTT was essentially equal to the amount that was written on the books as an asset held by Alameda. They essentially owned the entire market for this asset that they were claiming was part of their value. Now, this was already concerning because a few months ago, when firm Voyager filed Chapter 11 bankruptcy, they were rescued by FTX. During that process, it was found that Alameda owed Voyager $376 million. So FTX bailed out Voyager, acquired their bankrupt assets, when their own research firm, Alameda, owed them hundreds of millions of dollars. This was the story from that happening from late September. Crypto exchange FTX wins bankrupt firm Voyager's assets. But like we see here, their bankruptcy showed that Alameda owed them a bunch of money. So was SBF bailing out Voyager out of a sense of generosity, or was he really covering his own ass because he realized his company's valuations were propped up on Vapor and it hadn't yet been realized? So after the story came out, there was a lot of buzz on Twitter. It got spread around really quickly and everyone was wondering, is Alameda insolvent? They're a major market maker and investor in the space. If you take a trade on FTX, you're essentially essentially trading against Alameda. They provide liquidity in a number of different markets. So SBF put out a couple of tweets. This says 16 hours ago. This was actually from a few days ago. He has since deleted these tweets, but he sent this out and said, a competitor is trying to go after us with false rumors. FTX is fine. Assets are fine. We have enough to cover all client holdings. Well, after this news and after these tweets, FTX started seeing huge withdrawals. There was a lot of rumors going around on Twitter that it was in the billions of dollars a day for an exchange that normally sees a few $1,000,000 a day of outflows. A few billion is essentially a bank run. And during this process, CZ, who is the owner of Binance, which is currently the largest exchange and FTX's biggest rival, tweeted out, as part of Binance's exit from FTX equity last year, we received roughly $2 billion worth of FTT. Due to recent revelations, we've decided to liquidate any remaining FTT on our books. So they proceeded to send $584 million worth of FTT back to their own exchange in order to sell it. Since then, the market cap of FTT has tanked. Likewise, the price of FTT has tanked from around the mid-20s down to below $5 as of time of recording. And this was just remarkable to watch unfold on Twitter. You don't ever see this kind of thing happening in TradFi, where major events are happening with industry players and they're tweeting about it in real time. Here's more from CZ later that day. Liquidating our FTT is just risk management, learning from Luna. We gave support before, but we won't pretend to make love after divorce. We won't support people who lobby against other industry players behind our backs. So this seemed like it was a veiled swipe at SBF. He's been pushing for a lot of regulation in the space. He's become really friendly with a lot of people in Washington. And I think CZ maybe saw some of his moves as adversarial. Either way, it's clear that Binance noticed a rival at a moment of weakness, and they decided to press their thumb on the scale by selling $500 million worth of their native token at a moment of weakness. Now, during this event, while this was happening, remarkably, the CEO of Alameda herself, Caroline, tweeted out to CZ directly, if you're looking to minimize market impact on FTT sales, we will buy it all back from you at $22. Now that is funny because, as we pointed out, Alameda owns essentially the entire market cap of FTT. They have $3.5 billion of it on their books, and that was what the market cap was for the last few months. So Caroline comes out and says, we'll buy it all from you at $22. And what is $22? But the generational floor on FTT. Going all the way back to the beginning of the year, $22 literally is the support level. So I don't know if that is hubris or stupidity or a combination of all of those things, that the CEO of a firm on the verge of going under is tweeting out publicly that they want to buy back their currently bankrupt assets at the generational floor from their number one rival. Well, what do you know? That floor was broken by the market. So Caroline doesn't look too smart by tweeting this out here. She is the head of Alameda Research. We thought that that was the peak of comedy, to be frank. You can see my reply down here. There is no other market like this one. I was just floored that we saw this. But then, a day and a half later, the news dropped, the bombshell dropped, that CZ has offered to buy FTX. So not only was SBF completely wrong that FTX is fine, that their assets are fine, that they have enough to cover all their client holdings, but just a couple of days later, he had to bow down and surrender to his greatest rival and ask them to bail out FTX in order to make their clients whole. So CZ comes out looking like a king. He has essentially agreed to a, non-binding letter of intent. So now that this is public, CZ holds all the cards. He can choose to acquire FTX at a moment of weakness and pay pennies on the dollar. He's essentially acquiring bankrupt assets in order to further cement his place in the market, to absorb their market share. It's a brilliant move. And at the same time, if somehow during this due diligence process they find pieces of the FTX FTX balance sheet that are of too much concern for them. They can walk away from this deal without a scratch to their name. FTX will instantly go tits up, and Binance can walk away from the dust without any repercussions, except for the broader negative appearance that this puts on the industry as a whole. But Binance uniquely would be able to walk away unscathed. So really, they have a position of supreme power in these negotiations. It's a brilliant play by CZ. And if you are building a business in an industry and you have an opportunity to take out your largest rival at a major discount, you do it every single time. So it's not surprising that he is doing this. But really, the surprising part is that it is happening so publicly. So FTX folding to their biggest rival. And then just to throw salt in the wound, just last night, CZ tweeted out 2 big lessons. 1, never use a token you created as collateral. That is a direct swipe on Alameda. They have billions of dollars in FTT-backed loans that they were given by FTX. So essentially loans that are propped up by their own worthless token that they created themselves. They opened a circus, they created tickets for the circus, and then they circulated it within the circus as if it was currency. But no one outside of the circus found any value in those tickets. That is the exact analogy for what FTT is. It's the way that they propped up the valuation of their own research firm, Alameda, and it's just a signal of the larger toxic irresponsibility in the crypto space. Every time that we think we have found a business that's doing things the right way, it turns out that they're taking unbacked, under-collateralized loans and gambling with them, essentially, on the open market. We haven't found out any proof of this yet, but there's serious concern that FTX and Alameda were trading with customer funds. That's one of the reasons people are concerned that they don't have enough liquidity to service their customer withdrawals. We'll find out more of that as this process unfolds over the next few weeks. It's probably likely that that's the case. It's been the case in many of these other instances with what happened with Celsius, with what's going on with BlockFi. When you deposit your tokens into these various firms, they are rehypothecating them and using them to seek yield, and you are not safe. They are not doing it responsibly. There is not any regulation and guidance around how these businesses should operate. It's literally the Wild West. And when we see what happened over these last couple of days, that is going to have people in Washington and regulators really around the world chomping at the bit to get their teeth into this industry. They were already appetized by what happened with Luna earlier this year. And now that SBF, one of the biggest donors to Washington, one of their biggest friends in the crypto space, now that he has gone under for the same exact reasons that other people in the space have gone down this year, you think regulation was coming before? It is absolutely marching its way here now. I think the next few months will be very tumultuous. We're going to see more outcries to crack down on this space by regulation. Now, I've certainly not been in the crypto space as many years as other people, so I don't have the experience of what it was like living through the 2017-18 market, what the bear was like in 2019. I was still in TradFi at that time. But from my estimation, the rug pull of FTX might be the worst one ever because of their reputation, because they were upheld by the community as being one of the more reputable businesses, because SBF was a face of crypto. And while they had many detractors, by and large, they were considered one of the good guys. And it turns out that they were no more trustworthy than Celsius or Voyager or any of these other businesses. So this will leave a mark. This will take time to recover from. And I think we still have more bodies to float to the surface. When Luna collapsed and then it rolled into the failure of Three Arrows Capital a month later, many people felt like that was the worst part of the crypto bear, that we had already experienced our full capitulation, that those were the bodies we were waiting to float to the surface. But by appearances, we were too early to make that call, and it seems that we could have more bodies yet to surface. I don't really know. I'm certainly not an expert on all the goings on in this space, but just from the last couple of days, this is not what you want to see. This is utter Wild West chaos, irresponsibility at the highest levels of the industry. We're all going to have to pay a price for this in some way, either through inconvenience by legislation or from people outright losing their wealth due to mismanagement of funds. And, you know, this is just really surprising when you think about some of the other things that have happened this year. Like, it was just a couple of months ago, here in June June, when SBF was talking about how there could be other exchanges that may soon fail. This was after bailing out BlockFi and Voyager, which were likely done as a face-saving measure for his own business to hide their own fragility, particularly since they were exposed to Voyager. And here he is projecting that some exchanges may soon fail. And when he said this, there were a lot of people worried that maybe he meant KuCoin. Maybe he meant some of these other exchanges. Turns out he was talking about himself. If we look at the balance of Bitcoin on the FTX exchange, they have had a precipitous fall. Back here in March, at the height of Do Kwon buying Bitcoin for the lunar reserves, FTX had 119,000 BTC on their exchange. In the months following, it has been falling. It's been essentially in a structural decline ever since. So from 119K on March 29th, as of today, there's less than 6,000 Bitcoin on FTX in reserve by customers. So they are losing trust. They were already losing trust and losing customer liquidity over the last few months, and it has just been accelerated in recent days. This took them from being one of the 7 largest exchanges. Now they're all the way down between Gate.io and Luno, which are 2 of the smallest Bitcoin exchanges. Similarly, we can see their stablecoin reserves being depleted. This is a really volatile metric. It doesn't steadily move over time, but it has now broken down into lows that we haven't seen since the middle of last year. Stablecoins being removed. This is the withdrawal of cash by customers off of the exchange. So stablecoins collapsing on FTX, Bitcoin reserves collapsing on FTX. FTX may survive as a business, much the way that BitMEX still exists as a business after the liquidation event in March of 2020 that drove a lot of customers off their platform. They're still around, but in a very diminished fashion. That might be the future that we have to look forward to for FTX. Likewise, the Democrats lost a major donor. SBF was a huge contributor to political campaigns, particularly on the Democrat side. Alameda Research donated over $6 million to the Joe Biden campaign in 2020. And here, this is a story from about a month ago, October 14th, where SBF was talking about how he was going to give $1 billion or more to political races. Probably not going to happen now. So the tendrils of this saga reach into everything. They reach into finance, into politics, into regulation, and it's far too early to think that we're in the final innings. This bear market is still in the middle innings. We haven't even begun to see earnings slow down. We haven't seen any softening in unemployment, and both of those things are typical steps in a major bear. So I think that we'll see those developments over the next few weeks. And this week was already meant to be a bit dramatic because tomorrow we get a CPI report. If we look at the Inflation Nowcast, which is an algorithm run by the Cleveland Fed, it tries to guess inflation. It's been getting better at it. It thinks that what we're going to get tomorrow is a year-over-year 8.1 CPI with a 6.6% core CPI. That would be a new high. It thinks core CPI will be up 0.54% month over month. That's a pretty big jump. That's one of the larger jumps this year. Now, if we look at the predictions of the Inflation Nowcast tool, this is each month over the last year, and it's showing where the prediction of Inflation Nowcast was in relation to what the actual inflation print was for that given month. And here, from October, November, December of last year, it was underestimating inflation every month from last year, October, all the way through June. And then once we got to June, the pace of CPI began to slow down. It wasn't on such a rocket ship upwards, although increases have still been consistent. And after June, the tool started getting more accurate. In July, it slightly overestimated CPI, and then in August and September, it managed to guess it perfectly. So we can see it's getting more accurate. In the last couple of months, it hasn't been underestimating CPI as it was on the way up. It's a little more accurate now. So maybe we can assume that this is somewhat accurate. So tomorrow, we're probably looking at about an 8.1% CPI and a 6.6% core CPI, driven in large part by shelter, by rents, something we've unpacked on this channel a couple of times. That will provide more headwinds for the market, and the Fed has been open and clear that they want to see inflation subsiding in a multi-month series, and we're not yet at that point. This will be the 8th or 9th month in a row that we have 8% or higher CPI, and core is continuing to climb. The less volatile pieces are continuing to climb. I know it's probably frustrating for those of you who don't have a lot of market experience to hear someone like me come on here every week and tell you guys, keep being patient, keep remaining cautious, let the market give you signal. We don't really know what's going to happen. But all of those things are true. And if anyone is speaking to you with more conviction and more clarity about the direction that we're heading in, that person is probably not to be trusted, because we do not have a historical analog for all of these criteria happening at once. All we can do is try to marry together different historical eras into one amalgamated mush and try to gain clarity from that. It's extremely difficult. But one framework that I am using is one that I've heard referred to as the hope cycle. There's an economist named Michael Kantrowitz who works for Piper Sandler on Twitter. He calls it the hope cycle. But there are stages to a bear market. There are pieces to the economy that soften before others by the nature of their makeup. And we're still in the early innings. There are pieces that haven't even begun to show signs of being in a bear. And I believe that we are in a broad bear market that will take many more months to play out. So with that in mind, with that framework, these are the pieces of a bear market. Usually there are leading and lagging indicators. There are parts of the economy that show weakness before they are manifested elsewhere. One of those is in the early phases of construction. So before you employ labor, before you sell a product or a new home, you have to get a permit to build it and you have to start construction. Those are leading indicators, permits and housing starts. Here we're looking at housing starts, but they look almost the same. Typically, housing starts are one of the first things to begin softening from their highs. We're already starting to see that over here. The high was in April. Usually after you start seeing housing slow down, the early parts of housing slowing down, you also see a manifestation in new orders, which appears in the manufacturing and production side of the economy. New orders are indicative of future business and the anticipation of business conditions. So typically we see housing start to slow down, then we see a slowdown in new orders. It's already happening here. It's now down into contractionary territory below the 50 median bound. This is the ISM PMI new orders metric. So we've got a softening in housing, softening in new orders. Now this is where it starts to get a little tricky. The next phase is usually corporate earnings, profits. That's typically the next phase of the slowdown. You see a slowdown in new orders, a slowdown in expected business output over the next few months, and then you see a slowdown in earnings. You see a fall in projected earnings 12 months ahead, and then a fall in actual earnings. Well, we just came off a relatively successful Q3 earnings season. We haven't seen that shoe drop yet. You can see up here, earnings are still near their relative highs. Now, I'm showing earnings here as a percentile rank. It's a way of showing the oscillations over time, because otherwise this line tends to just kind of drift upwards as a result of monetary debasement and earnings just always growing. So we're looking at this a little differently here. It's more like an oscillator, and you can see it has not oscillated back down in any meaningful way at all. So we're in between these two phases of the market. And if you look down here at unemployment, this is unemployment inverted, right? Because I wanted it to show the same directionality as the lines above it. This is what unemployment normally looks like. But let's flip it over so that when it's coming down, that means that employment is getting worse. People are losing their jobs when this metric is going down because unemployment is upside down. It is still basically at its highs from this perspective, which means, as we were just explaining, it means that unemployment is at the lows, right? But it hasn't moved yet. So you can see where we are in this process. We've got a softening of housing starts, a softening in construction. We've got a softening of new orders, of the expectation of business. But then we've got a stall out here. Corporate earnings have not responded yet. We've looked at this a couple of times throughout the year, and I've been a bit confused as to how earnings can remain so bullish. And I think that there is still some elasticity in that market, and it's apparent here. So we are in the middle phases of this bear market. We haven't seen earnings rolling over. We haven't seen employment rolling over. Those two things need to happen. And when they do, assets will fall further. That is what helps to inform my base case that we have not seen the lows in crypto or in equities. They may not arrive this week. They could arrive a couple of months from now. But I want to share with you, my audience, the framework that is informing my base case. And this is one of the ways of illustrating it by seeing the different phases of the economy. And you can clearly see the first two phases have rolled over and the next two haven't at all yet. So that is where I want to leave things today. I really wanted to talk about what happened with FTX and Alameda, the buyout by Binance, and how that affects the crypto industry broadly. I think it encourages the appetite for regulation in Washington and in other jurisdictions. We're going to see more of that in the coming months. It was already on the way after what happened with Luna. It has now been pushed into hyperspeed as a result of the events of the last couple days. It goes without saying that if your coins are still sitting on an exchange somewhere, they are at risk. There are no industry standards to protect your property as it sits on an exchange. Some people might argue that they're safe at a place like Coinbase, which is one of the most regulated entities in the space, but I don't believe that. I don't feel that way. I don't trust my Bitcoin sitting on any of these exchanges. I keep the vast majority of it in self-custody, cold storage all the time. I will send it to the exchange in the instance that I ever feel like selling some of it, but outside of that, it remains in my custody with zero counterparty risk. And that is what I recommend everyone take some sovereign custody of your own wealth. At least give it some consideration. Make sure that you follow me right here on Twitter at TXMC Trades. And while you're at it, check out my newsletter. I launched this a couple of months ago. It's a place where I express some of my longer form ideas, where I show more of my research, and I get to share a bunch of charts that don't make it into my videos. You also get links to my interactive chart books. So please go check out my newsletter. It's at alphabetasoup.io. There's a link in the description to this video. It's also the pinned tweet on my Twitter bio. I appreciate you guys checking it out. All the proceeds go 100% to me. So thanks for looking at it. And that's where we'll leave it today, friends. There's much more that we could talk about, but I wanted to keep this video really focused on what happened with FTX the last couple of days, how that immediately impacts the market, and where we're sitting in the general bear process. If you have any questions for me or any feedback, make sure to leave them in the comments down below and I will read them. If you enjoy this content, give my video a thumbs up and subscribe to my channel. I appreciate all of your support as I try to make this into a career and escape the fiat rat race. Share my content with your friends, help me get the word out. And that's where we'll leave it. So we will talk in a few days from now. We'll see how these things play out. We'll look at the CPI report tomorrow, see how the markets unfold over the next couple of days, and we'll have a few things to discuss the next time we meet. So until then, take care of yourselves, friends. Take care of each other, and we will chat in the very near future. Cheers, everyone.